We're going to do this today. We're going to talk about trusts and how that can be used to maximize what people are calling the SALT deduction. So, SALT deduction is amazing because now it went from $10,000 to being $40,000. So, what that means is state and local income tax. So, you have real estate taxes, you have income taxes. If you're in a state that has income taxes, using your personal tax return to maximize to the 40,000, great. But guess what? Now you can also use the same thing. You always were able to use the same amount on a trust, but now the trust also has $40,000. So if you have different income producing properties or investments and you are in need of doing trust planning, and you no longer really have to worry about doing estate planning because 15 million if you're single, $30 million if you are married. Many people are not going to be really focusing on trying to save estate taxes because they're under the limit. So they're going to be hyper focusing on income tax savings. So you can have a trust set up for each of your children and divide up some of your assets to create income there, and you can maximize on the $40,000 SALT deduction. You can do a little bit of combination with the PTE tax structure. If you have a property that has a lot of real estate taxes as an investment, same idea. Maybe that's a little less prevalent in a lot of situations. So I was reading an article today, and we all know trust can be a very powerful way to protect your wealth, obviously, because this trust protect your wealth, but also to protect your tax savings and to optimize on that. So there's sometimes there's other things to think about, like Section 199A QBI deduction, and maybe you're not able to take that QBI deduction because you made too much money and you didn't have the W-2s or you didn't have the assets in there, but you had business income and you made too much over the threshold and now you're phased out. By dividing and diversifying and shifting income into other entities that are like standalone, like a trust, you can really get away from and optimize your savings. An example of that is you have four different trusts that you are going to generate income that's going to generate state taxes. And you could do $40,000 on each of those. As long as you are allowed to open up multiple trusts, IRS has a special thing. You got to be careful that if you just kind of open up all these trusts and all your kids are all beneficiaries of each of the trusts, IRS could look at that as being one big, beautiful trust, right? So the one big beautiful bill allows $40,000, but you have to be able to have a reason for why you had that trust. So we tell clients that you should make each trust one kid per trust, individual like, beneficiaries of those trusts, and just one person, and then it's a separate trust, and it's not one big trust because this is for this kid to take care of this kid's needs. This is for that kid. So that's the way to go around it. So, what else could I say? There's a lot of other little things besides for SALT that I wanted to touch upon. There's QSBS, Qualified Small Business Stock. What does that mean? If you go on a lot of the internet and you try to figure out tax strategies to save a lot of money on taxes, if you are a stockholder in a C corporation and you have it held for 5 years and it's a qualified small business, you can have a $10 million gain exclusion, section 1202, and actually it's gone up in 2026. It could be even, I believe, 15 million, and there's a little bit of different ways you can get that gain. So if you use trust as being the shareholders of some of that stock, you can have more free tax-free gain. So you have to really think about it. That's a tremendous planning if you have the foresight to put away stock ownership with a trust. And these are the things that trusts do not just to protect wealth from creditors, not just to make sure the beneficiaries can't just spend all the money on, G-Wagons and all that kind of thing. So that's what I wanted to bring to your attention. There's not a lot of people talking about this. It's a huge way of really utilizing those trusts. And by the way, I'm Mo. I'm a tax strategist, CPA. I work with high net worth individuals, business owners, and one of the things that I've always done all through the years is worked on trusts. Occasionally worked on the estates, worked on estate and trust planning. When I was working back in the day, I have 17 years of experience. We didn't have a very big, high exclusion for trusts in the state. So we used to do a lot of planning, a little bit less now. I have a couple clients that are worth $60 million. I have a lot of real estate investors. They, unfortunately, specifically one of them I'm thinking about, they didn't really do any planning. So they own all the stuff outright. When they go to heaven, they're going to have a pretty sizable taxable estate, at least $30 million worth. Let's say it's worth 60 million. So when that goes to the next generation, they're going to have a big tax. But whatever, they're rich. They didn't really care right now. Maybe they'll live another 120 years and do something there. Who knows, right? They're 75 years old now. The point of the matter is, make sure you have a good advisor, a CPA that works with attorneys to be able to create this amazing path. We call it the Trust Trifecta. That's what a lot of people like to say. We got like the ultimate setup, the trifecta. Because everyone thinks about going to the what do you call that thing? The horse racing, the trifecta. It sounds great. Only rich people do that. Anyway, follow me for more tips. I'm going to talk about this more, talking more about trust and estate planning, why it's important, why it could help. And of course, follow us